Welcome to today's webinar. My name is Rebecca Self. I'm the Director of Sustainable Finance at South Pole, and I'm delighted today to be joined by a number of expert guests, and we'll be talking about conservation finance and the release of a new report. And this was a collaboration between many partners and supporters under the umbrella of the Coalition of Private Investment in Conservation. And with that, I'll hand over to John. Thank you.
Thank you, Rebecca, and I hope you can all hear me. My name is John Tobin. I'm at Cornell University, and I'd like to tell you a little bit about this report that we have, which is hot off the press on the current state of the field of conservation finance. The report, so in order for you to understand the background, grew out of a collaboration between CPIC, the Coalition for Private Investment in Conservation, as it is known, South Pole, and a team at Cornell University with the support of the American Bird Conservancy and the GEF, the Global Environment Facility. And the intention in doing this work was to respond to the need for data focusing on the area of sustainable finance, including capital flows into conservation investments, the kinds of conservation assets that these investments are going into, geographies where these investments are focused, expected trends, and so on. Nothing revolutionary. In fact, many of you are probably familiar, for example, with the Climate Bonds Initiative yearly reports that do the same for the green bonds market and many other areas. So it should be self-evident why finance sector professionals, conservation project managers, and others might want data in this area because it allows an assessment of the potential of the area, the growth, the trends, etc. And the reality is that there hasn't been, until now, a concerted effort to compile, put together, analyze, and digest and put in a report information on the field on a regular basis, say yearly or biennially, that would allow us a better understanding of how the field is changing over time and what we might expect going forward. There have been, as some of you will probably know, a small number of studies that have tried to quantify capital flows into conservation. The most recent of these was probably the work of Forest Trends and collaborators that was published in 2017. They call this report the State of Private Investment in Conservation 2016. This 2016 data published in 2017. But you could certainly count the number of studies that looks at the field, looks at the investors, looks at the investments, and tries to get a handle on what are the amounts, what are the magnitudes, and what are the trends. All of the efforts up until now, however, and this is key, have been one-offs. And a key distinction between this earlier, very important, and in some cases, like in the case of the Forest Trends study, painstakingly detailed with large amounts of data. But key distinction between that earlier work and the work that we'll be talking about today is the objective of collecting comparable data over time on a regular basis in order to understand trends in the field. So if we can go to the next slide, that would be terrific. Thank you. Now, in particular, we'd like to establish a baseline for what return-seeking investments are being made into conservation in terms of amounts, return expectations, actual returns, the kinds of financial products in which investments are made, and related metrics to this. And we want to understand which projects are attracting the investment from sustainable finance investors, as well as, if possible, mainstream investors, though gathering or collecting those data are harder, as well as how these projects that are attracting investment, and this is a crucial point, how these projects that are attracting investment are different from the projects that cannot or have not attracted investment up until now. So let's get to the point. We conducted detailed, and it's likely that some of our respondents may say painfully detailed, surveys on a relatively small number of actors in the space, consisting of 35 organizations, and you see them here on the right-hand side of the slide. Roughly 1/4 of these organizations are investors, and another 1/4 are project developers. So half of all respondents here are represented by either the providers of capital or the recipients of capital, while the other half of the respondents, approximately, are other organizations that are currently in this space. Intermediaries like large NGOs like the Nature Conservancy and others, or academics who are working in this field, or research organizations, or other advocacy organizations that are supporting in some way the growth of the field of conservation finance and facilitating deals in the space. The investors and recipients of capital collectively represented about $1.3 billion in investment in 2020, which is represents some substantial growth compared to some of the other work that has looked at the field, but as you can probably appreciate, is still relatively small, and we'll say a little bit more about that. Let's move on to the next slide, please. So, other key findings of the report. The market seems to be growing fast, though from a very low base. And actually, maybe we should switch to the prior slide for this. Almost all of the capital is being invested in private equity, in private debt, and in real assets. So the number of different financial vehicles that are absorbing the investment capital in conservation is quite limited. And in terms of the ultimate industries or products that are receiving the investments, the ones that stand out are sustainable timber, sustainable agriculture. These are the dominant areas that are attracting capital. Now, one point that you may have focused on or considered is the fact that notwithstanding the name conservation finance, most of the capital is going into activities that result from a transformation of the landscape. So one criticism that has been levied against some of these investments is the fact that while the activities that receive the investment are more sustainable than the conventional alternatives in, say, forestry and agriculture, they still result from a transformation, in most cases in the distant past, from a natural habitat to a managed habitat. That we fully expect on the basis of the trends that we have seen so far by comparing some of the data that we have with data that's been reported in earlier work, that the growth in conservation investing that is strictly about conservation is going to increase over time. And what are those areas? Ecotourism, for example, provides the archetypal conservation investing in that sense, in that people are paying for the service provided by the ecotourism manager of allowing an experience in an untransformed conserved habitat. Green and natural infrastructure, another area where the economic activity that is receiving the investing results in a conservation of natural habitat, as opposed to, in the case of much of forestry and almost all agriculture, a better management of transformed landscapes compared to the alternatives. So I'd like also to speak about some of the obstacles to growth in the Christina, we should probably move to the next slide. Yeah. One of the key obstacles to growth in the field, at least until recently, when a lot of work is taking place in this space, is the metrics of non-financial returns. Risk-adjusted returns in many of these investments, calculating those is no different from calculating financial returns in conventional investments. But the complication, of course, in sustainable finance, as you will all appreciate, is the fact that in addition to financial metrics, we're looking for metrics that will tell us something about what those non-financial returns are. What is the impact? In other words, how do you quantify whether an investment has had real conservation results? And even more difficult from the point of view of the investor. When making investments, how do you compare two different investments that do not use the same metrics? Because an investment in preserving, say, coral reefs will not deliver the same metrics that a project that intends to preserve a group of species would. Those of you who are more familiar with carbon markets might not appreciate this, but the carbon space is blessed with having this universal language, this widely shared metric in the forms of metric tons of CO2 equivalent, as well as an internationally agreed public policy goal, 2 degrees Celsius or 1.5. Not having that metric and that clear goal from a policy point of view is a real handicap in conservation finance. Is that going to change? Are we going to develop metrics that are going to allow greater comparability? Well, there are already some out there, as some of you may know, that are starting to be applied, but we still have a little ways. Now, I should also highlight by respondents as being more impactful than others, with forestry and agriculture being reported as highly effective by 72% of our respondents. At the opposite end, oceans and coastal areas, most respondents report, most respondents report that area is not delivering the same level of highly effective impacts, with the 72% of forests and terrestrial ecosystems coming down to a 32% reporting their oceans and coastal area investments as highly impactful or highly effective. Next slide, please. Yeah, from this, I would like to highlight the fact that the future of conservation investing looks bright from a number of different points of view. For most actors in the field, there seems to be optimism. The investment, the amount of capital coming into the field is growing, at least compared to what we have been able to find in the past. And I should qualify that by saying that estimates of earlier capital invested are not entirely comparable to those numbers that we have here, but they're close enough that we feel comfortable that there's growth in the field. Plus, if you spend any time in the sustainable finance space, which many of you no doubt have, you are, I am sure, quite aware of the fact that the amount of new activity in the area of, call it biodiversity finance or investing in nature, or however you might want to describe it, it has just exploded in the course of the last, say, 2, 3, 5 years. That's reason for optimism if what you're looking to do is attract capital to fill the so-called biodiversity financing gap. But there are problems. There are serious problems that make the entry of at-scale capital, because $1 billion a year really, for all intents and purposes, represents a small number of transactions, as we have found in this work, many of which would best be described as pilots. The reality is that investing in carbon, and specifically investing in alternative energy, has a built-in revenue stream, which is electricity generation. And yes, there may be issues about pricing in certain jurisdictions. We know the pricing is coming down for alternative energy generation. But in the field of conservation finance, generating revenue from conservation activities can be a real challenge. The fact is that the pipeline of transactions that we see and the availability of investments today for investor does not meet the demand. Interest on the part of investors to deploy capital in such a manner that it delivers biodiversity benefits as well as financial returns far outstrips the availability of deals that are reasonably attractive from a risk-return perspective. And that is something that, from the point of view of the project developers, may be a blessing. You have investors to choose from, except that you have to get over that obstacle of, how do I generate revenue from a conservation project that is reliable, that is attractive, and where risks are appropriately managed? With that, I would move on to the next slide, and the final slide for me, which is the conclusions. And Christina, there we go. I don't want to dwell on the conclusions. Some of these I've touched on already, and I see no sort of great need to dwell on them. But I do want to highlight the second to last that touches again on metrics, but also on other information gaps that we find are preventing faster development in this field. And that is precisely what this report is looking to address. I invite all of you to download this report. It is quite a handy, user-friendly, relatively short report with some useful information for those interested in the field. And hopefully we'll be seeing further iterations of it in the future going forward. So, Rebecca, thank you.
Thank you, and thank you very much for those introductory words. The report link is available in the chat, so you can find it there. And from some of the work I've completed and South Pole's completed in the carbon markets, definitely recognise that development which you stated, and perhaps some of the learnings that can be taken from carbon, from climate, and moved over to some of these areas, new and emerging. So I'd characterise it as lots of opportunities, but more to do. Thank you. And if you do have questions, a reminder, if you could please put those into the Q&A box, which is along the bottom of your screen. And there'll be a moment after the panel introductions and discussion where we'll get to some of those questions. So then moving on to the panel, and I'm very pleased to be joined today by some real experts in the field who each have their different perspectives. And we'll turn to each of them one by one for a few opening introductory words as they can give their own thoughts and their own perspective on this report, on the topic. So without any further ado, I'll start with Edith from Morova to give the private finance perspective. Thank you.
Thanks a lot, Rebecca. Good morning, good afternoon, everybody. Pleasure to be here, and thanks a lot for the invitation to participate in this panel. So my name is Edith Kiss. I'm Investment and Development Director at Miro Natural Capital. We are an impact investment asset manager who have actually started our journey on the space of nature-based solutions in 2013 with our first flagship fund, the Althea Climate Fund, which actually has been investing at the nexus of climate and conservation, and we can touch a little bit on that how we do see the opportunities there. And indeed, I can confirm that since the beginning of that journey, the past few years are very promising, and there is interesting developments on the market. I'm also working on some of our more recent newer generation funds, like the L'Oreal Nature Regeneration Fund, which is an impact investing fund with a corporate, which is also, I think, a very exciting type of new developments where corporates are getting involved beyond their supply chains and recognizing that that's really important, but not fast enough. So, for example, this is an example of a fund that is a financial return fund, but long tenure, so patient capital, and really targeting the issues around biodiversity, conservation, and climate change. And also one of our newer projects, so the Nature Plus Accelerator Fund, which is a collaboration between IUCN, Jeff, CPIXO members. A very pleasure to share this panel with our partners that is actually looking to address some of these challenges, which are very clearly identified in the report, and we look forward to work on that and launch the fund very soon so that we can accelerate together. On the report, it's really great to see. Congratulations with it. I think it was a very well needed piece. Indeed, there has been quite some reports previously which was giving an overview of the global or the aggregate market, including public, and one of the things which I think the report also clearly also highlights is that the conservation finance space or market is very dominated by public funding. Obviously, it's a public good, so not a surprise. But just to put in perspective, out of the $140 billion that has been deployed in 2020, only like less than 20 billion is private, and obviously this report is a subset of that. So yeah, we still need a long way to go, but clearly, as with the climate finance as well, we recognize, I mean, the market is recognizing hopefully that the public money will not be enough, and we need to catalyze, and that's, I think, we have been working on how to create a business case, how to create the model, as Joe mentioned very well, as piloting, trying different approaches, and I think that's what is exciting, that it's finally taking shape. Another thing, maybe by reading the report, is interesting to see, and of course it's not surprising to us, but it's good to see on paper as well. When you look at those reports that show the aggregate picture, you also will notice that the recipients, or where you have the investment directed, is very much concentrated in the developed world, which is again not surprising because policies are more advanced there. And here in this private sector angle report, you can see that actually most of the flow is going in the developing world, where you have the biggest impact for private capital. As an impact investor, we always look where our $1 is making the biggest impact, right? That's how we try to optimize our limited funding investment capital. So very nice to see the actually good distribution between Latin America, Africa, and Southeast Asia, and again that suddenly you see the private sector is trying to fill the gap where the public sector is lagging behind. And maybe one last point, I would just pick out the report, which I found interesting to see that 12% of the revenue streams, which only 12% comes from carbon. Obviously, sustainable commodities has been, and supply chain approach has been, again, a fast growing space. So that's great to see. The biodiversity and other environmental assets, that's something I think is going to accelerate as well. It's interesting to see already like 19%. I think the difficulty with that one is the local nature. So it's very hard to replicate or scale. That is why there are some new tools like the STAR tool, which hopefully we'll have time to discuss, which gives us hope that is able to maybe a bit globalize it and make it a bit more standardized across countries. So that would be an opportunity to scale. And the carbon, I think, is where during the climate week is something to mention that obviously we have seen a tremendous growth on the voluntary carbon markets, and I think it's very fair to say that it has been fueled by the nature-based segment of the market. So it's not surprising investors, corporates, and the new participants, I think they do recognize the twin wins of climate and biodiversity by using these type of credits. And I think based on the latest report from Ecosystem Marketplace, we are close to $1 billion to reach $1 billion this year. So still very tiny if you think about it. Again, if you look at the hundreds of billions of financing gap, but it's set to grow. It's had to continue to grow, and I think so it is also a tremendous opportunity for the conservation space, but also something to watch, as there could be trade-offs between biodiversity and climate. So I think those are a few opening thoughts, and very happy to discuss further in the discussion. Thank you.
Thank you. And yeah, I really took away that need for private capital and patient capital as well. I think that's really important. So with that, I'll turn to another perspective, which is from the Global Environment Facility, and AVRL, which is a multilateral trust fund. Over to you. Thank you.
Thank you, Rebecca. It's a pleasure to be here this morning with you and to comment on this very important report and very timely indeed. So thank you for the effort and the invitation to comment on this. So the Global Environment Facility, just 2 words on that, is the financial mechanism of multiple conventions, including the UNFCCC or the Convention on Biological Diversity, amongst the 5 that I mentioned and that are relevant for this discussion. As such, what that means, being a financial mechanism, is that whenever a decision is taken in the context of these conventions, there is always guidance on how countries can implement the policies or design the policies and implement them. And the GEF helps and supports mostly governments with grants in doing so. There is nevertheless a smaller portfolio of money that I lead. It's on the Blended Finance Initiative, and that helps or has as an objective to mobilize private sector investment into environmental areas of concern. And what we've seen, and this is, it's important because the set aside or this pot of money is designed to create the risk and return profiles that will help the private sector invest in areas that are very challenging. We were there 25, 30 years ago with climate change, trying to prove new technologies, renewable energy, energy efficiency. I think we've now come to a point in which we, in many countries, not in all, but in many countries, these are already bankable technologies, and we find commercial banks just providing financing for these types of projects, many project finance. But there is another set of environmental aspects for which this report is incredibly, I would say, timely, but also shows with data what we've experienced throughout 3 decades of investing in conservation. First of all, I wanted to mention that although in the 90s and early 2000s, the investment from the private sector in conservation was very limited, we are seeing in the last decade increased interest, and now I would say 2/3 of our projects have an aspect that includes either land degradation or biodiversity conservation together with climate change mitigation. And that brings me to the point of nature-based solutions, or what we were saying, or one of the key findings, which was landscape level investments, is that for the private sector to invest in conservation, usually the structuring, the financial structure and the revenue streams that come from project investment not only come from conservation activities, because that's very, very hard. It takes a very long time monetizing these types of services. Up to date has not been, I would say, resulted in a scalable type of revenue stream. So what we see in the type of investments that we support is that projects support indeed sustainable agriculture or conservation, but they do so including the potential of the soil and of the practices to capture carbon. And with that, we generate from the very early stages of the project revenue streams that can repay for investments. But what here is also important is that in these risk return profiles, when we talk to investors, first of all, we see that there's a total gap of knowledge, going back to what was said by John earlier, and track records on these types of investments. And second, there's a lack of assessment of risk that has to do with the environmental aspect. That risk on the environmental aspect can result in a creditworthiness risk in the future, but we so far have no data or reliability or track record created for that. So at the GEF, we, as a donor, we provide grants, but also non-grants, meaning types of instruments such as guarantees, equity, and debt to help mobilize private sector investment. And we have found out that these instruments are more useful for the private sector than pure grants. And in the blending of both, meaning our concessional or subsidized type of rates that we require as a donor and the commercial finance, we tend to find risk return profiles that are acceptable for investors. That said, then what we are more encountering more and more is the pipeline of project, or how do we originate these projects. And for that, we think that technical assistance is very important, and that these types of projects require usually a little more preparation, or I would say making them ready for investors that have serious or requirements on risk and return. Finally, I just wanted to say that this integration of environmental areas, meaning we are not only talking about conservation when we present a project to an investor, but it has a climate change mitigation aspect. It can also have a land degradation aspect, and therefore we can structure it. We're also seeing a lot of innovation. We're seeing innovation in the creation of asset classes. We just saw, I think last week, that there in the New York Stock Exchange, there's a company that is launching natural capital companies to try to capitalize the value of natural capital. To be seen what's happening, but that's an innovation. We are also talking about conservation bonds, so bonds that can finance the survival of certain species with a lot of activities in the ground. And we are also seeing, and that's the other reason why we are, I think, optimistic, that many commercial banks, big commercial banks, are creating now teams in conservation. There's not only climate change mitigation specialists now, we see BNP Paribas, we see Credit Suisse, we see HSBC coming more and more to create teams that will help these banks understand the opportunities and risks. So in that respect, these types of reports and the experience that Mirova or that we have can help in scale up as fast as we can, as it's needed. Thank you. That's all for me.
Thank you very much, and I very much appreciate the optimism as well. It sounds like there's some reasons to be optimistic there, thinking around some of the momentum that's been seen recently, and then also where climate has come from and carbon, and perhaps seeing that replicated in other areas. So great to hear that. Thank you for the perspective. So final opening words, and last but not least, over to Thomas, who'll be giving a non-profit perspective on this area, and he's speaking from IUCN. Over to you, Thomas.
Wonderful. Well, thank you so much, Rebecca. I hope you can hear me, and I would assume that silence means that you can hear me. Well, no, I think you know this study, this report is extremely timely, and obviously I think that it shows clearly that there is an increasing momentum around conservation finance and increasing interest from the private sector, in particular, of course, from the financial institution, that they have a role to play in actually filling that gap and really supporting those conservation enterprise so that they can deliver both, of course, socioeconomic as well as conservation outcomes. Because the reality is, I think it's very straightforward. Science tells us that there is certain targets that we need to reach by 2030. And right now we are nowhere close to actually having the financial means to actually achieve those. And unless we actually turn our economies into nature positive economy, well, otherwise the reality is that it's very simple. We just won't reach those targets. And that means, you know, all the sort of the bad scenarios that the last reports from the UNFCCC and others have depicted. So now the question is, and I'm going to talk, of course, primarily from a blue economy perspective. Reality is, I'd say the blue economy is probably where the green economy was 30 years ago. Now, that also means that 30 years ago, people were starting to say, wow, look, we can actually come up with like conservation enterprise that are actually good for both nature and the people. And we're going to start building them, looking at regenerative agriculture, agroforestry, and they're actually starting building a nice sort of pipeline of initiative. Eventually, at one point, what happened is that they would not be able to meet with the financial investors that would actually be keen to start investing so that they could scale up. And eventually, sort of the financial sector decides, there is actually there is an opportunity for us to start investing. And then we've seen about 15 years ago, more or less, the birth of those first impact investment that really and deliberately focused on conservation enterprises. Now, since then, obviously, I think there is many success stories and there is more and more everywhere, which is extremely positive. But quite interestingly, what happened is that the financial sector that first focused on the green economy, then suddenly, because of course we made a lot of noise that there was lots of opportunity also on the blue economy, and they say, okay, great. Then we're going to do something. We're going to just pull together those very large investment funds from blue economy, and then we're going to pull money into those bankable projects. So then they come back to us and say okay, now we have those funds, ocean, sustainable ocean investment fund and this and that. So where is the pipeline of bankable projects? And that's where there is the issue, is that the green economy had 30 years to actually develop that pipeline of bankable projects. We don't, and we have not yet had those 30 years, and the reality is that we don't have that time. We don't have that luxury in a way to actually develop, in 30 years such a pipeline of projects. So what the issue now, and pretty much every week, if not every month, I receive investors coming and say like, yeah, we have like those millions we need to invest, and we want to invest to like blue economy projects, etc. Where are they? Where are the bankable? What there isn't. Now, it doesn't not mean that there is no potential. It just means that we actually need to build that pipeline in a record time, obviously, because basically we have 10 years to do what the green economy maybe had done in 30 years, or even less than 10 years. So now that means that we absolutely need to invest much more upstream than eventually what the green economy now is able to absorb. So much more early stage. And that also means, for instance, that the type of instrument that will be required would be much more like seed funding, equity type of funding instead of debt. Because for debt, you need to already have some sort of running operation to be able to repay a debt. Right now, as I said, those type of businesses in the blue economy are almost non-existent, at least in my region in Africa, which I know might be very different from, for instance, Southeast Asia or certainly Europe. But when you look at Africa, that's certainly the case. So now how do we build such a pipeline is, I think, certainly the nut that we need to crack. That means that we need to invest into, from the ideation type of processes. As a matter of fact, as IUCN, we are now launching in the region what we are calling an Ocean Venture Studio, which literally means that it's going to become some sort of like Ocean Ventures factory to generate that pipeline of what would eventually in 2, 3, 4 years from now will become a pipeline of bankable project. But that also means that we need to support incubation type of program, acceleration type of program, so that eventually, again, in the next 3 to 5 years, there will be a pipeline of bankable project that will then, and only then, be able to absorb the level of investment that today is actually available, and it's going to sit there because for now there is no sort of real project that is able to absorb. So now just one last thought. It's on the key finding, I think the key finding number 2, which sort of outline a bit the impact effectiveness of investments. And if you will remember, one of the lines says that only 38% of the investment in ocean and coastal areas is considered as highly effective, and 50% as somewhat effective, and 13% as. So I just want to make sure that we don't misinterpret that slide. It doesn't, because also, when you read that, basically an investor might think, oh wow, if I want to have a proper and sort of more, higher impact, I'd rather invest into forest and terrestrial ecosystem than in ocean. Well, I haven't seen exactly how that, that number has been built and pulled from, but I want to make sure that, this is not misinterpreted, meaning that I believe, and I would strongly believe that 38% is only accurate because, and only because there is yet not enough a pipeline of bankable, impactful projects or initiatives that are yet available. And most of what you'll see, and actually it'd be interesting to actually see the details of the type of investment that have been in coastal areas. I would very much think that it's mainly sort of coastal infrastructure, maybe a bit of tourism, some into industrial fisheries. And of course, then one might argue, well, are those the most impactful type of investment? And indeed, therefore, maybe the translation is that, well, maybe not so much, and then only 38% are actually highly impactful. Now, as I said, the big question is, how can we get the 38% to reach the 72% or actually the 100%? Thank you.
Yeah, thank you very much. I think I might be feeling a bit more gloomy now, but perhaps in the interest of balance, that's not a bad thing. Because of course we do know there's a lot more to do. And thinking about this, bankable projects, new types of projects, and how to grow that pipeline, perhaps I'll turn to Edith. It'd be good to understand, without getting into any specificity, of course, but just at a very high level, how, with a sort of private investor perspective, how you see that, any comments, how you can make that happen?
Yes, thanks. It's a very interesting question and very important one. And I would maybe just say that, one thing for the market is very good with this. Once you have a signal, and I think Avril mentioned the risk-return ratio. So I'm a strong market believer, having worked on the private sector all my career. But, if you give a signal, if you get the right signal. So what, for example, happened in 2013 when we started investing in forest conservation projects, with an impact angle. So the conservation angle was very important, but we thought carbon was more advanced, and back then it was still nowhere where it is today, right? And we have been strongly, our thesis was, if there is a signal on the carbon price, that's gonna go much faster, and that's what happened in the past 8 years. There is a signal on the pricing, there is a carbon price. There is an exchange that just launched a few weeks ago, a future contracts on it. So we have price signal up to December 2024. Then I can tell you that there is a bit of a lack of supply, into the sense that there is a bit of inertia. So you need some time to develop these projects, but these projects are now fully bankable, fully investable. So there are investors who turn, putting millions of dollars into these type of projects. There is, of course, other challenges there, how to go to scale from project to jurisdictions and all that. But that was definitely we have seen in a very short period of time. So I'm quite optimistic that if we can learn and we can replicate that in the conservation space. So that's why the TNFD is so important. And once we have disclosure requirements, and once investors are already interested in nature positive and investments, but once we have the metrics, as also John mentioned, it's not ever going to be as easy as on climate. But if you have suddenly some signals, and this type of investments will get some sort of, in the beginning, the way we see is that you could create some sort of maybe carbon, still building on the carbon angle. And what the market is doing right now is differentiating already some premiums perhaps for some of the SDGs, especially biodiversity, but others as well. So SDG premiums for SDG, positive SDG impacts. So on that pathway, you could imagine that first it's a high biodiversity carbon, and hopefully it becomes a biodiversity asset over time. And if you have that kind of signal, I think we can go much faster, and the business case will be there, and the incubation time will shorten. In the meantime, it remains a complex issue. Ecotourism and others were mentioned. It's going to be always difficult, and very context specific. So I think we will still need a lot of technical assistance, blended finance, all that. But I'm quite positive that if you get the right market signal, if we get that signal also that John mentioned, the target from the COP, hopefully from the CBD COP, if you get a global goal that everybody can work towards, you have new standards emerging. IUCN has this new global nature-based solution standard. We have new metrics emerging. I think we can accelerate, and we don't have to wait for the 30 years. We have to wait on renewables and forests.
Yeah, thank you. Good to hear. And that importance of having those conditions, the supportive conditions around enabling the markets to grow and to have those projects which scale, including signals. Yeah, really interesting. Thank you. So probably turn to the Q&A and see if there's any questions so far. Please continue to put any questions that you have in there. But perhaps posing the first one, how can we deploy social impact capital from grants to relatively high ROI seeking impact investment more strategically? Why aren't there more international partnerships between grant makers and impact investors? And so, Avril, perhaps over to you on that one.
Yes, thank you. So I had responded in the chat in case there was no time to respond. This Arturo, thanks for the question. Indeed, perception of risk by investors in the US and Europe is high. And when we're talking about conservation, most of the highly valuable biodiversity hotspots are in developing countries. So you need to add the emerging market type of risk consideration. However, we see, in our experience, most of the investment we've done in this area is by providing de-risking mechanisms, and that can be what that can mean to you or to any type of public sector provider of funding is to structure the support in a way that it provides a de-risking and a quantifiable risk return number for the investors. So usually if you provide a grant that goes in forms of technical assistance, it's not structured as a little cushion for the first loss. But if you structure your support in a way that you can be there as patient capital, lose it all if needed, but the other investors can have a potential to get an IRR or an ROI, as you were saying, I think that would be the way to go.
Yeah, thank you. And perhaps a question for John, and this is coming from the chat, and a quick question on the report. Well, I'm assuming a quick question, but does the report get into the opportunities and challenges of blended finance for conservation? This hasn't been discussed much here today so far.
No, it has not been discussed here yet. And my immediate reaction to the question is, yes, there are very real challenges and opportunities for blended finance in conservation finance, but I'm not sure if they are qualitatively different than they are in other forms of sustainable finance, whether it's investments in low-income housing or in education or in alternative energy or any other field in the sort of very broad world of sustainable finance. The fact is, if anything, there may be an additional need, particularly early on, and others have remarked on this. Thomas has remarked on the fact that blue finance is 30 years behind green finance. Well, people in the environmental finance space often say that we're 10 years behind people in, or the developments in the area of social finance. But even within environmental finance, conservation finance is way behind other forms of environmental investing. So while there are probably no material qualitative differences in terms of the opportunities and challenges of blended finance for conservation finance, because of the earlier stage of development of conservation finance, the relative importance of blended finance that will help, tip those transactions that are close to being profitable, but not quite, in the absence of concessionary capital or some guarantee or a grant that will reduce investment or upfront costs in the project. The ability of that blended finance to push those deals over the line and directly into execution mode is potentially even greater. But yeah, I think the difference is one of quantity rather than a significant qualitative difference.
Great, thank you. And a couple of times, Edith, I think you mentioned some of the frameworks which are coming up. So for example, the TNFD, the Task Force on Nature-Related Financial Disclosures, and also a framework by IUCN. And perhaps there's other new frameworks to aid disclosure, aid the analysis of impact on the blue economy. I'm not too sure on that myself, but curious your thoughts on that particular topic, Thomas.
Right. Yeah. No, that's, it's of course, the question of standards is absolutely critical because it's going to help actually sort of set a way to actually track, of course, the impact. Right now in the blue economy, there is nothing really, that specific to the blue economy, at least not that I know. It doesn't mean that, it cannot be developed, and it has to be and will be. But right now there isn't such standard only or like specifically for the blue economy. Now, if I may, I'd like also to sort of build a bit on the blended finance question, because I think that's a very, very key and very certainly will be a very important piece of the solution if we actually want to build such a pipeline that I've mentioned. When you look at actually the genesis or sort of the history of the blended finance movement or thing, you know, the reason is that, as I sort of mentioned before, you know, first there was like the project developer, then they couldn't meet, you know, the investor, that eventually like the green economy started to, or like those green impact investments started to increase. And then eventually they said like, wow, you know, we do have money, but it's still very risky. So it would be good, you know, if we can come up with a mechanism that can lower the risk for us and make sure that, you know, we can secure a bit more or give a bit more security to our investors. Okay. Then we're going to come up with this sort of blended mechanism, which means that you are de-risking the investment from the investor. You're not de-risking the risk from the operators, right? They hold the entire risk. So yeah, sure. Of course, once you already have some sort of like pipeline of project established that are waiting to receive funding, then it makes sense to have that. Now, the question is, when you don't have such a pipeline, and now actually it's the other way around. So you know, John, you say that the blue finances were the blue green finance was 30 years ago. Well, actually, not really. What I say is the blue economy is probably where the green economy was 30 years ago. Now, within the blue economy, you will find actually that the blue finance sort of subcomponent is probably like maybe like 10 years where or like around like where the blue green or the green economy or the green finance was 10 years ago. So I guess my point is more advanced than the rest of the blue economy. And that is that basically now you have like those investors, they're like, yeah, I absolutely want to invest into blue, but there is no, so how do you do? And that's sort of what my point I want to make. When you look at actually sort of the blended finance, of course, you need to de-risk the investors so that they can actually, you know, unlock the investment. But critically, when it comes to the blue economy, we need to blend that finance even more. So not only of the type of financing that you're going to actually sort of blend or de-risk, which means that, for instance, if you want to support much more early stage type of businesses, you have to de-risk more particularly equity or early stage type of investment, not necessarily equity, right? So that's one. Now, it also means that you need to go much more early stage, and as I said, invest upstream so that eventually, like 2-3 years down the line, then you can actually unlock that more commercial type of funding, including equity. So that means that this grant, eventually money that you might have or might be ready to lose or invest it very early stage so that by, you know, then you can actually support the creation, establishment of those business that eventually will become bankable and will really sort of become that pipeline of bankable projects. So that's why, you know, we need to blend it in more in time and be much more deliberate in the type of instrument that we want to blend so that they are more adapted to the type, you know, the maturity of the blue economy.
Yeah, thank you very much. And I think we're coming up to time. I know there's a few more questions. If you download the report, there's an email address for CPIC. And so please do shoot any questions there and they will be responded to. I think we've reached the time for today's webinar. And a few of my own personal takeaways, having those right market conditions to support these types of projects, these type of investments is really important, including signals, price signals, looking at risk and return. Disclosure, frameworks, data and impact is also very important, as well as having that blended finance and this seed finance to really kickstart some of these projects in the first instance to then make them bankable and scale them. Ultimately, and that's what, you know, the planet needs, speaking frankly, all of us need. So thank you so much for joining today, very much appreciated. Thank you to the panelists and wishing you all a very good day wherever you may be. Take care. Thanks.
Thank you.
Thank you.
Thank you.